Hello and welcome to this ACCA AFM presentation. And on this particular video, I want to look at how to read ACCA AFM questions in an efficient and an effective manner. Now, this video is not going to look at how to answer the example question I'm going to use. However, I am going to bring in some technical points. I can't deny that because it's a natural part of when you're doing how to read a question in an efficient and effective manner. If you want videos on how to answer the question, then obviously that's part of what is going to be my courses. But what this is about is when you are in the exam room or outside the exam room and practicing questions here, in this case on practice platform, yeah, how do you ensure that you pick up the key trigger words, key points, trigger words, trigger points within the reading of the requirements, which allows you to pick up the relevant information from what is going to be the question to produce a really good AFM answer. Now, one of the reasons to present this video is that in a recent meeting we had with the ACCA examiners, they mentioned the fact that a lot of students don't pick up the relevant information from what is going to be the exhibits to answer what is going to be a question in the correct manner. And what I want to do in this particular video is to make sure that we can address that and address it thoroughly and properly. Now, I'm using a question from the specimen paper called Colvin. Many of you may have done this question already. Many of you may do this question in the future. But I'm using it as an illustrative, come on, son, put your teeth in, illustrative example, illustrative situation to show you how to read questions in the correct manner. We can see here that they tell us there's 3 exhibits. Okay. It looks like an investment appraisal question straight away. Project information discount rate, investment appraisal question. Starting point, requirements. So we have the requirements, and a great word to start with, evaluate. And in that recent meeting we had with the examining team, one of the examiners mentioned how students are interpreting evaluate in not the correct manner. It is not just here's the decision, it's a more encompassing answer than when here is the decision. We've got to look at the other factors that are going to build, to arrive at that decision. Evaluate the suitability of the investment proposal. Investment is, it sounds very much in project appraisal, including the impact of country risk premium on net present value. Country risk premium would indicate to me that this is an FX MPV question. And I'm, again, just from the read through here, just from the requirements, Cambia looks like it's going to be the foreign country here. Okay, so I've got evaluate, project appraisal, foreign country, country risk premium, not sure about. I'll have to come to that when I read it, but definitely an MPV. Discuss. Discuss means positive and negative. It means all round. It doesn't mean just advantages. It doesn't mean just disadvantages. It means both the positive and the negative, the validity of the chief executive reasons for adjusting the discount rate to appraise the project. Now, this adjusting discount rate, to me, it triggers a technical area of AFM. Risk adjusted WACC. Risk adjusted WACC. And if I can pause a second, and I hope you have listened to some of my podcasts, but one of my podcasts on all things ACCA AFM with Sunil Bandari is I talk about when we use risk adjusted WACC. And one of them is when you take a core project into a high risk political and economic country. And that's the glory. I won't take the glory away of that podcast. But again, discuss positive, negative. Chief executive, I want to come to in a moment. Discount rate thinks that are a WACC for this project abroad. Now, let me again, this chief executive, right? You are writing, even though this is not a report answer. Remember that you're talking about a chief executive. You may well be working for this company. You may be advising this company. Yeah. So when you are looking at this chief executive's reasons, you must make sure that you present your answer in the correct, professional manner. And the way I always like to think of this, and this may be a crazy way of thinking of this, but this is why I think of it. I always think that when I'm talking to my 97-year-old mother, and I mean 97-year-old mother, I touch wood here, yeah, that when I'm discussing something with my mother and I know that she may not be correct, I am from an Asian background. I am not going to argue with my mother and tell her outright that she's incorrect. I'm going to listen to her point of view. I'm going to understand her point of view, and then I'm going to put the alternative point of view across. And that is what I mean about being professional. Don't be blunt, be professional. Okay. And here we get marks for the A&E. And again, examiners are saying A&E is good. Where the marks have been not so good is scepticism and commercial acumen. And I'm going to take the opportunity in this question to ensure that I show you where we're going to pick those marks up. Now let's turn our attention to the three exhibits. First exhibit, Colvin is based in the Eurozone, home currency euro. Established 10 years ago to manufacture competition standard bicycles for professional road racers. Those who do things like the Tour de France, Tour de Italy, Tour de Britain. Yeah. The company obtained a listing 5 years ago. The founder retained a small minority holding. The remaining shares are held by institutional investors. Apart from the fact of what they do and the country, not much there I can pick up on. The board recently decided to expand the range of models. So they're going to do product development and look for new growth opportunities abroad. Whilst manufacturing is currently restricted to the Eurozone, the board of directors have identified Colombia as a key growth market. So they manufacture in Euro and are now going to sell abroad. Considering a potential investment for product to manufacture and sell a new model there. Okay, so they're going to set up a factory and then distribute from there. This would involve setting up a subsidiary. The subsidiary would be a separate legal company. And the point I would be picking up here as a separate legal company is that they will be liable to tax in their country. We'll be liable to tax in our country. We will also have the opportunity to do elements of transfer pricing, yeah, in this area because they're a separate company, we're a separate company, and we've got to again keep that in mind. So I understand what they do, I understand what the company is, where they're based, and what they are planning to do. Exhibit 2. The currency of Cambia is the Cambian lira, CL. The current exchange rate is CL 9.91 to the euro. That is what you would call indirect presentation. Any CL would be divided by that rate to give to euro. Any euro would be multiplied by that rate to give you CL. Okay. The annual inflation rate in Cambia is expected to be 10% throughout the 4-year duration. Are they giving us that to adjust the cash flows, or are they giving us that to work out prospective spot rates? And if they were going to use prospective spot rates, that would then be what you call HC in a PPPT calculation. The FD has estimated sales volumes, inflation adjusted pre-tax contribution and fixed costs. This is very nice of us. So they've given us physical quantities, right, in units, but they've given us the pre-tax contribution in millions. Now, that is indicating to us that when we do the spreadsheet, it's perfectly okay to work to one decimal place or two decimal places in millions. They're indicating you that they're quite happy with one decimal place. If you do one or two, I don't think there'd be an issue on that particular basis. So just to repeat there, whether you do one or two decimal places to millions, that's perfectly fine. Yeah, perfectly okay. Yeah, in terms of what is in your presentation. They've given us these units for a reason, so there's got to be something coming up. The project required immediate investment of 75 million in land and buildings and 700 million in P&M. Okay, TAD. Now we think of TAD here. Yeah, taxable depreciation. On P&M, is straight line at 25% of cost. So what that means is we've got to take the 700 million, times it by 25%, and allocate it in years 1, 2, 3, 4. Apart from, well, let me rephrase that. Take the 700 million and allocate it at 25% in years 1, 2, and 3. But in the final year, there'll be a balancing figure. That's what I'm thinking at this point in time. Yeah. And remember, the total TAD must be the what you buy the asset for less what you sell it for. That's the total TAD, which means in the final year there would be a balancing figure. But let's see if there's any scrap value. Okay, Colvin's FD believes that the plant and machinery will have a zero scrap value in year 4. Oh, well, okay, then it's nice and easy. It's just 700 million times 25% in years 1, 2, 3, and 4, because the final year will be effectively a balancing figure equal to what you've had in all the other years. The land and buildings will be disposed of at the end of the project life for a tax exempt value at an annual inflation rate of 30% throughout the 4-year period. Now, this is where when you're looking at that ready for the spreadsheet, you're thinking, okay, when I go and put my land and buildings line in, it'd be 75 million at zero. And in the final year, I know it's got to be the 75 million multiplied by 1.3, 1 plus the inflation rate, compounded for 4 years to the power 4. Yeah, to the power 4. Yeah. And we know, like I said, from a recent meeting with the examiners, if you put that in a cell and the marker can see that in year 4 as a cell, 75 million times 1.3 to the power 4, that's all they need. You don't need a working for that. You don't need a working for the working capital either. The project will also require an immediate investment of working capital of 25 million and annual incremental working capital flows as follows. Now, on the working cap, they've actually told us what the numbers are. Let me pause here for a second. Yeah. When you're looking at working capital, I have a video on this. It's within the tuition material. Yeah. And it also happens to be on my YouTube page. And what you always remember with working capital is you've got to invest at time naught, you've got to adjust it up or down each year, and you've got to take it out in the final year. So this is a very nice question because they've told us you put 25 million in at zero, it's increase by 2.5 million, increase by 2.8, increase by those are physical numbers. You then add them all up, and it's all got to come out in year 4. It's all got to come out in year 4. And remember, the working capital row, when you look at it on your spreadsheet, must add up to 0. So a lot of technical stuff in this answer. Yeah, a lot of technical stuff in this reading, right? So what this reading of the question is doing is making me think about my presentation. I'm beginning to feel rather comfortable with this particular presentation. I'm thinking this looks all pretty good at the moment in terms of approach. And they've told us about the working capital coming back at the earliest point. So that looks perfectly fine. What they mean by the dividends is the net flows in CL have to be converted into euros at the end of each respective year. So everything looks okay up to there. I feel very comfortable up to there. Then it says all components for the new bicycle were produced or purchased in Cambia except for a gearing system, which will be manufactured in the Eurozone. I stop there and I think to myself, I can smell transfer price here. Reading the question, triggering my mind into AFM knowledge, transfer price. The cost of acquiring the components in the Eurozone is included in the pre-tax estimate and based on a transfer price of 10 euros. Right, so this is what they've done. This 10 euros, and this is where you've got to interpret the data. They have basically said they've been sending this gearing unit across to Cambia and been charging 10 euros per component, only one gearing system per bike. So they've been basically going 10 euros times by a relevant quantity, converted into CL, and has been included in these numbers. And if they've been included in these numbers, they've been included as a cost. So when they say pre-tax contribution, my estimate of that is they've got sales in that country, less what is going to be the local costs, less the transfer price. So they've done that already. They've done that for us. So I'm thinking, wonderful, brilliant. You've done that already for us. So why are you telling me this then? The FD estimates that the cost of this is 2. That means that we have made a contribution of 8. Again, I'm pausing. I'm thinking about the effect on my answer. And the effect on my answer is I'm going to have what is going to be a transfer price profit of 8 euros in years 1, 2, 3, and 4 in what is going to be my investment appraisal. So once I've converted their currency back into my currency, do I have any additional flows in my country? Yes, I do. I have 8 euros multiplied by the respective quantities as what is going to be a profit earned in my country. Okay. Both the transfer price and manufacturing cost must increase in line with inflation in the Eurozone of 4% for the first 2 years and 2% for years 3 and 4. So that means that when I work out, for example, the contribution in euros in year 1, it's going to be a difference of that's 8 multiplied by the quantity multiplied by inflation for 1 year of 1.04. When I do it for what is going to be year 2, the quantity multiplied by 8 times 1.04 squared. Yeah? And then when I go to year 3, it's going to be 8 times the quantity times 1.04 squared times 1.02 for year 3, etc. Like I said, I'm not trying to present the whole answer. I'm just trying to say on the read through what my mind is thinking I've got to do. So that's going to be a little bit of work on it. And then I've got to pay tax on that contribution. I've got to pay tax in my country on that contribution. Okay. Corporation tax in Cambia is 25%, and they are allowed to carry losses forward against future profits. Stop. That as a trigger to you, you would think to yourself in investment appraisal questions of FX MPV, if you've only got one subsidiary abroad, the loss has to be carried forward, right? Because you've got nothing to offset it against. It'll be set against future profits. Colvin's tax in his home country is 20%. Fantastic. There is no double tax. The taxable profit earned abroad is taxed at the higher rate. So We don't have any additional tax to pay in our country on their profits. However, we do have to pay 20% on the profit of the transfer price. Right? That's our tax that we have to pay here. And the liability is paid in the year it's incurred, no time delay. And there's a bilateral tax agreement, but we don't have to worry about that because the higher tax rate is already paid abroad. So a lot of that read through, I can't deny, is a bit being a bit techie about what I'm going to do because of the nature of it. But what I'm always looking in a question is, right, it's helping me here. Yeah, it's helping me. Yeah, it's giving me a mindset that I've read it. I know what I'm going to do with it. I've read it. I know what I'm going to do with it. I know where it's going to come into play. I also know that I've got to predict the spot rates. But when I predict the spot rate, HC will be 10% or zero point 0.1. HB, the home inflation, will be 4% year one, 4% year two, 2% year three, 2% year four. So I'm going to predict the spot rates based on that at time zero. So again, a bit of a techie read, that one, I don't deny. But the nature of the question of the data exhibit made it techie. And that's the exhibit I'm going to need predominantly for what is going to be part A of this particular question. Now the remaining exhibit. The board proposes a project mix of equity and debt in such a way that existing capital structure remains unchanged. Stop. What does that make you think when you're reading that? That would make you think that if capital structure is not going to change, from your AFM knowledge, that would either be saying we use the company WACC or we use the risk adjusted WACC, because those are the two situations when capital structure remains constant. That's also mentioned in the podcast. However, we know that this is a project where from the original data, we already know there is some economic issues. Why do we know there's some economic issues here? Because their inflation is running at a constant 10. Our inflation in the Eurozone is actually coming under control. So it seems that there is some economic differences between the two countries. Also, they're paying a higher tax rate than us. And that often leads again to the idea that there is an economic differential. One of the reasons you might be paying a higher tax is the government needs to basically raise that money. And we don't need it so much effective in our country, in the Eurozone. So again, these are how you use the information for hints as to what you're going to put in your answer, particularly when it comes to the idea of dealing with the discount rate issue. Let me go back to this exhibit. Yeah. Okay. For the purpose of the project, the chief executive believes the WACC of 13% should be included, should be adjusted to include a country risk premium on the basis of developing economy and appears to be less stable than the Eurozone countries. That managing director, that chief executive is correct. Correct. I would agree. I would agree. I think you have to adjust the 13%. The company WACC is not relevant. You have to use what is going to be some risk adjusted WACC, and they want to adjust it. She's made the decision after consulting with the country index and the standard deviation of market returns. Okay. Additional factors include the foreign exchange risk. Yeah, accepted. The fact that there is frequent changes of government. Everything here. Look, this is one of the things the examiner was saying in a recent meeting. Look how the data is telling you what to do. It's saying to you, oh, right, you've got big political changes there, you've got economic issues there, you've got different tax rates than our country. Yeah. So that's indicating some element of what is going to be a change in the discount rate. And they've come up with a discount rate of 16%. So you've been asked to use a rate of 16%. So I've got a lot of information there I can use. Yeah. So let me now go back to the requirements. Yeah. Which I'm obviously going to copy it into my answer and make sure I've used that information into what is going to be my answer. So returning to the requirements, I'm now clear on how I'm going to do my calculation. I'm very clear in my mind. But there's one thing I'm now much clearer on another point now. What do they mean by the impact of the country risk premium? And I believe what that means now is to do the NPV twice, to actually get the cash flows converted into euros and use the NPV function once at what is going to be 16% and once at 13%. And what that will then enable us to do is to look at what is going to be what the differential between the NPV is. And my guess is, and I'm just taking a guess, because at this point I haven't done the question. The NPV at a higher discount rate is always going to be lower. It wouldn't surprise me if the NPV at 16% is negative and the NPV at 13% is positive. So at the WACC, you should take it at the what is going to be at the 16%, but it says reject it. And then on the evaluation of the suitability of the project, we've just got to bring some other factors in apart from what is going to be the NPV. Comment on that evaluation of the suitability. Yes, we're going to talk about the two NPVs, but I think we also have to talk about the country that we're investing into, a little bit about whether we believe it's got the stability we want. I think we certainly want to do a sensitivity analysis on some of the key cash flows. We need to consider that, in terms of a suitable investment. And there's no mention of any real option. I think we wouldn't. I think we would like to have an option to exit the project early, just simply because it's the first time that we've gone abroad. Yeah. Also, again the first time we've gone abroad, the experience of it. Yeah. For instance, how are we going to set this subsidiary up? Are we going to put our managers in? Are we going to have their managers there? So within the 14 marks, we've got to talk not only about the number, yeah, but also about the other aspects of it, which are derived from the question. Yeah, into a new country, not into a new country. The fact it's our first project abroad, it's outside the eurozone, it's a subsidiary, the cash flows, the real option, etc. On the validity of the chief executive's view of adjusted discount rate, I think what you would want to build in here is everything they've shown you within the question. Yeah. So the fact that they've got different different tax rates, that indicates an issue on economic stability. The fact that they've got different what is going to be different inflation rates, which affects both the cash flows and what is going to be the idea of a factor related to economic stability. We know the number of changes of government are an issue. So we are saying that the chief executive is right in concept. We would say the chief executive looks like they're right in concept, and there's plenty of aspects to say reasons that they should be looking to use risk-adjusted discount rate. The bit on the negative side here is there's no mention where they got the 16% from. I mean, it looks arbitrary. There's no explanation of where the numbers come from. And that's where you could possibly mention there the idea of risk-adjusted WACC approach, where there is some sound basis for doing a risk-adjusted WACC approach without having to explain the full calculation. The idea of using what is going to be a risk-adjusted approach, but from what is going to be adjusting a relevant asset beta. But the concept that the chief executive is saying is correct. It's whether the number that we're using is correct. And that is this 30-minute video on how to read ACCA AFM questions in an efficient and effective manner. I very much hope it helps.